So the whole point of building a business, in addition to hopefully creating cash flow for yourself, for your family, for your team, and building a large, scalable, impactful asset in the world, is to create something that is sellable that you can one day move over to a buyer and receive a multiple on your sales or on your EBITDA, hopefully one that is very favorable and that can serve as a reward for the years put in of work and allow you to live and reinvest in a way that you desire. So in this lesson, I will explore a few essential factors that you want to make sure to consider when you are evaluating a potential acquisition, as well as if you are thinking about selling your business. So I will draw from my personal experience here. I have worked on platforms like Flippa and Biz Buy Sell in the past. I've listed businesses, I've bought businesses, I've made more than a couple mistakes. I've had a couple of good decisions and successes. And so that will lead into kind of delving into some of the critical aspects that you want to think about when you're considering whether a business is worth buying and is a right fit for you. So let's jump right in. I narrowed down kind of 7 things that you want to look at when buying a money-making system, aka a business. So number 1 is going to be MRR and ARR, which means that you have customers on recurring payments or you have cash flow coming in a repeatable fashion month over month. When considering a potential acquisition, you want to pay close attention to the consistency and the growth trajectory or growth rate of both of these metrics, because a business with a strong base of customers on recurring payments not only provides a predictable revenue stream, but also signifies customer loyalty and satisfaction, which are both really important for continuity, right? And that will enable you to predict with hopefully a high degree of certainty that this business will provide you with recurring revenue into the future, right? Having these metrics and being able to see, 12 to ideally 24 or even 36 months into the past of how much is the business making month over month is very, very useful. The higher degree of certainty that you can have, that demonstrates the business's ability to acquire and retain existing customers, the higher the probability that you're going to be successful into the future. Additionally, you want to analyze the churn rate to ensure that the business can maintain its subscription base effectively. All right, number 2 is proprietary assets. This could range from intellectual property rights like patents and trademarks to unique technologies, processes, branding elements even. And the whole idea here is that proprietary assets, while they're not money makers in and of themselves, typically, right? Typically, there's another mechanism that is responsible for bringing customers in and retaining them. But what assets like tech or branding or IP or patents can do is they can provide a bit of a moat for you, which is your competitive advantage that creates barriers to entry for potential competitors and enhances your business's valuation in aggregate, right? And so you can conduct thorough due diligence to really understand and evaluate the strength of the assets in the business. And it very well may be the case that there are none. With a lot of small service-based or client-based businesses, they're fairly commoditized. And so it could very well be that the main asset that you're going to get in investing in a business like this is just the existing customer list, the existing install base, which maybe is only 15 or 30 or 45 customers, depending on the business that you're looking at. So you're not always going to have you're not always going to have patents and IP and all of these things, right? But if they're there, they can be one indicator of quality and of defensibility for the business you're looking at. Number 3, high margin business. Profitability is obviously the lifeblood of any successful business venture. So as you assess a potential acquisition, prioritize businesses with high margins that generate substantial profits relative to their revenue. High margin businesses are going to have greater flexibility in weathering any economic downturns. They're also going to allow you to invest in expansion opportunities more readily. And of course, rewarding stakeholders if you have investors who have a stake in the venture that you're buying. Also, analyze the cost structure of the business to identify areas for optimization and margin improvement. Keep in mind that while revenue growth is important, look at net margins and look at gross margins, and then get to work on identification of areas where you can improve both of those. Number 4, high NPS and customer satisfaction. So the satisfaction of customers is a direct reflection of the business's value proposition and operational excellence. And so financial metrics, while important, they don't tell the full story, right? You really want to dive into customer feedback and satisfaction ratings NPS and customer reviews are the two biggest ones. A high NPS score would indicate strong customer advocacy and loyalty, which are critical for driving organic growth and minimizing customer churn rate. Also, scrutinize customer testimonials and reviews so that you can gain insights into the business's strengths, weaknesses, and areas for improvement before you buy. Remember that a satisfied customer base not only fuels revenue growth, but also is going to enhance the business's reputation, brand equity, and word of mouth into the future as you look to take market share either deeper into the existing market or as you look to expand horizontally across markets. Number 6, growth potential. So evaluate the growth potential of the business beyond its current state. What does this look like? What you want to look for is opportunities to expand into new markets, to diversify product offerings, or to enhance operational efficiency. So those are really the 3 big pillars in terms of growth. Markets, you can either verticalize or you can go more horizontal, so deeper into your existing market, or like I was just talking about, getting into different markets, different customer bases. That's one. Product offerings, if you only have 1 or 2 products now, what would it require to develop 3, 4, 5 different product lines that can hopefully complement one another? What kind of additional cost of goods sold would that incur? Is it worth it? Et cetera, et cetera. These are the types of questions to ask around product. And then operational efficiency, right? Can you produce the same yield for a cheaper cost? A business with untapped growth potential not only presents opportunities for increased profitability, but also enhances its attractiveness as an investment for you. And then number 7 is scalability. So look at the business model and the infrastructure. A scalable business can efficiently accommodate growth without proportional increases in resources or costs. So look at key aspects here, such as production processes, distribution channels, and customer acquisition strategies to ensure that the business can actually adapt and grow in response to changing market dynamics, kind of regardless of any externalities or what happens in the world. Do you have a system which is capable of being replicated across instances, across geographies, and across technologies? So those are the 7 things to think about when you're considering acquiring a new business. Now, when you're selling your business, what should you be looking at? So there's a few things that I outlined here that you want to be thinking about. One is exit strategy alignment. So ensure that your exit strategy aligns with your long-term goals and objectives. It's essential to have a clear roadmap for transitioning out of the business. So consider factors like timing, valuation, of course, is important, tax implications, legacy considerations. All of these things come into play when crafting your exit strategy to maximize value and maximize continued success for the thing that you spent probably the last 5 or 10 or 15 years of your life building. And then I just alluded to business valuation. That's point number 2. And so you should have a goal for what you want to sell your business. You should know what your valuation is now, and then you should have a North Star of what you're trying to get to, and you should know what you would sell at. If there's a number that you would say yes to right now, you should know what that number is. So I'm not going to go into the nitty-gritty here of assessing the worth of your enterprise. You can just Google that, right? And there's different formulas that you can use around EBITDA, around annual sales, et cetera. The reason that a precise valuation is essential for negotiating with potential buyers or investors is to ensure that you receive the maximum value for your hard work and investment, but also so that you don't turn people off or turn people away by asking an unreasonable amount for the business. And then thirdly is transition planning. So when I sold my social media brand, New Earth Knowledge, I wanted to make sure that I moved it over to somebody who was going to treat the audience and the brand right, somebody who would respect the energy that I put in and hopefully who could continue on with that energy and merge the page and merge the IP into what they're doing in such a way that it would be seamless and almost native for the followers, many of whom I'm still in contact with to this day, and who I care about, right? And so as you lead up to this, start documenting your key processes, procedures, contacts, customers, vendors, employees, and all stakeholders across the business to help minimize uncertainty and mitigate potential disruptions down the line, which will help eliminate the chance of buyer's remorse from your eventual acquirer. It may even be that your acquirer wants to bring you over, this happens often, to consult or to even work in the company for a predetermined amount of time to help with the transition process. A lot of times, if you're open to doing that, it can make your business more attractive when it comes time to sell to a successor or to new ownership. So that's really all I've got for this lesson. By considering these additional factors when buying or exiting a business, you can make informed decisions that maximize value, mitigate risk, and ensure business continuity so that your buyer or yourself, depending on which side of the pendulum you are on, remains as happy and as prosperous as possible into the future.